You guys may be getting a little tired of looking at BDCs after the last two. Well, we're switching it up today, looking at an equity REIT in way of STAG Industrial Incorporated, stock ticker STAG. STAG Industrial concern themselves with purchasing single-tenant industrial properties in the United States in order to generate rental income and distribute it back to the shareholders. The other way REITs make money are by generating income from mortgage and interest payments. These are called MREITs. Of their annual taxable income, all REITs are required to distribute at least 90% of it back to their shareholders. Remember, these dividend payments are taxed at the investor's ordinary income tax rate. STAG Industrial Inc. currently has a share price of $39.76, giving them a market cap of $6.441 billion, with a 52-week low of $29.34 and a 52-week high of $43.55. Given the current share price, STAG is currently trading minus 8.7% from that 52-week high, and they have a beta volatility of 0.9. This past year has been fantastic for the earnings history of STAG, and they have most recently reported an earnings per share or EPS of $1.09, resulting in a price to earnings ratio of 36.33. Although this price to earnings ratio does seem a bit high, it is important to use this fundamental metric relatively, and we can see here that STAG's PE ratio is the sixth lowest compared to their industrial REIT peers. However, when performing fundamental analyses on real estate investment trusts, it is important to look at a company's funds from operation or FFO rather than their earnings. This is because the accounting practices, depreciation, and amortization skew the annual earnings reported by these companies, making EPS an inaccurate estimate of true performance. Funds from operation conveys the operating performance of a real estate investment trust by adding depreciation, amortization, and losses on sales of assets to their earnings. Gains on sales of assets and interest income are then subtracted, giving investors a more realistic picture of the income generated. FFO is sometimes expressed as a multiple, which is calculated by dividing share price by the FFO per share. STAG Industrial's FFO multiple of 20.5 times is much lower than their industrial REIT peers at 33.3 times. Similar to a PE ratio, a lower FFO multiple signals a company can do more with less, generating greater earnings without needing an inflated share price. STAG Industrial Inc. currently has a dividend yield of 3.69%, resulting in an annual payout of $1.45 per share, which is paid monthly. The company has a beautiful payout ratio of 71.21%. In addition to these great dividend stats, STAG has increased their dividend for 10 consecutive years now, making them a dividend contender. Don't mind the beginning of the graph, they switched from quarterly to monthly payouts, but their dividend growth rate and payout ratio signaled to us that management places the utmost importance on their distributions and attempting to top the dividend aristocrat chart. STAG currently has a price to book ratio of 2.55 with $16.29 million in total cash and $1.94 billion in total debt on their balance sheet. Additionally, they report an operating cash flow of $308 million and a levered free cash flow of $162.17 million. Now, something we consistently talk about on the channel is how interest rates will affect companies with large amounts of debt, such as REITs and BDCs. STAG's conservative approach make them a safer investment than some REITs, as 85% of their interest rates are fixed. Additionally, only 24% of their debt matures through 2023, which is advantageous for the time being because this aligns with the Fed's timeline to increase rates. STAG Industrial has reported profit margins of 34.12% and an operating margin of 28.5%, with a return on assets and return on equity of 2.04% and 6.97% respectively. Fundamentally, STAG appears to be a solid monthly dividend stock thus far, but is their efficient debt management enough to generate annual returns competitively given the climate around interest rates? One of the largest factors in STAG's ability to generate high returns is their business model as well as their opportune market. The U.S. industrial market is currently more than $1 trillion in total size. Although their opportunity set spans the top 60 plus markets, STAG has recently begun to shift their focus to e-commerce activity. E-commerce sales as a percent of the total US retail sales have grown consistently since 2013, taking a huge leap given the pandemic. Although it has recently leveled off, the US retail inventory to sales ratio has crashed over the last year, which is backed up by this chart showing that e-commerce growth rates are declining, despite the percent of total retail sales continuing to increase. With this opportunity, STAG Industrial Inc. has been able to grow their portfolio immensely since IPO in 2011. Their 501 current properties span a total of 100.1 million square feet across 39 states, which is an increase of 13 since inception. Even more impressively, STAG has been able to reduce the rate of flexible office space, which they rent out, from 21.1 to just 0.3% of their annual base rent, or ABR. Not only does this make STAG a safer investment, as their leasing contracts have become less flexible, but it also gives them the ability to maintain more consistent dividend payouts. In addition to that superb geographical diversification in STAG's portfolio, they also span 60 plus markets with exposure to 45 plus different industries. Their largest tenant only accounts for 4% of their total ABR, which is beneficial in the case something happens affecting the business with a specific tenant. With less than 30% of their leases expiring through 2023, STAG has positioned themselves well to protect their portfolio against a volatile economy. More safeholds they have in place are in-depth credit analyses of each tenant, as well as diversifying tenants by revenue exposure. Their top 10 holdings can be seen here, with Amazon leading the way at 3.9%, followed by other companies who benefit from e-commerce. Speaking of e-commerce, obviously the opportunity is there, but has it paid off for STAG, making them a better investment during the current market conditions? Year to date, a $10,000 investment in STAG Industrial would prove to return 17.03% more than the Spider S&P 500 ETF, resulting in a final balance of $13,860 in just 10 months for STAG. Additionally, STAG was able to beat out their peers on average, shown by the red line or Vanguard Real Estate ETF. In the past, we've always looked at a company's one-year stock chart, but we're switching it up to the 2-year for the time being. I want to do this because the one-year chart no longer factors in that March 2020 crash, which I believe makes it fail to accurately convey the price movements. STAG's 2-year chart shows they have quickly recovered successfully, showing 2 large run-ups over the past year with candles much higher than the red 20-day moving average line. They have begun to pull back a bit recently, however, as their valuation began to get too high, expressed by the overbought status on the purple relative strength index. Of the 12 analyst price targets, the average lies at $43.88 with a low target of $35.50 and a high of $50. The big question here is whether or not STAG will be able to beat out the annual returns of the S&P 500, especially if e-commerce is not boosted up by worldwide shutdowns, because STAG's market cap is already so high. With that being said, however, I do believe that the management team has done an effective job and will continue to do so in regard to raising that monthly dividend and keep it safe with a low payout ratio. Alongside that, the seemingly growing business opportunity and low market correlation do make STAG a good investment in my opinion, especially if your own portfolio weighting in real estate is low. I hope you guys enjoyed the video. Remember to subscribe to the channel, give me a thumbs up, drop some real estate investment trust ticker symbols down in the comments. We'll look at them next. As always, I'm Patrick Zimmerman. Thank you for your time. Have a nice day.